This is video number 3, entitled The Guest House, and I'm going to summarise the advantages and disadvantages of the two scenarios of buying a guest house in a limited company or buying it in their personal name. So number 1, their prospective accountant advised them to put £250,000 in share capital in a limited company and to buy the guest house, together with a loan of £750,000. The trouble with that, it's very hard to withdraw the money from your limited company if it's shown as share capital. An easier method would be that you actually put that down as a director's loan and then withdraw the money. Now, some limited companies, some people have to buy the properties through their limited companies because the companies have the money and they haven't got the money personally. However, in this case, they were starting up with a brand new company, so it didn't make any difference from their point of view as to whether a company bought it or whether they bought it in their own name. The trouble with if a company buys it is that if the purchaser wants to buy the guest house and not the shares in the limited company, then that means that the limited company would sell the guest house and then pay chargeable gains tax at a rate of 25% on the gain of £2 million, i.e. the property would be sold for £3 million in 10 years' time, but purchased for £1 million. So we know that the company is going to pay 25% corporation tax on that. However, if they own it personally, then they have an exemption of principal private residence relief because they live in the property and that's their only property. So the bit they live in, the area, square area, that would be exempt from capital gains tax. The second thing is they can get a lettings relief, and that lettings relief is up to £40,000 lettings relief. And because they own the property jointly, then they can each claim that lettings relief. They've also got a capital gains tax exemption, which we know is £3,000 in the year ended 5th of April 2025. In addition to that, as individuals, the maximum rate of capital gains tax they'd pay is 20%, whereas if the property was sold in the limited company, we know that the company would pay 25% corporation tax. They may also be able to claim something called BAD-R, business asset disposal relief, on the sale of the property, and that may reduce their final capital gains liability down to 10%. So that is very powerful. The other thing to note is if you make a loss in the first trading year of a limited company, you can only offset that loss against future taxable profits. However, if they own the property in their own name, i.e. a partnership, and they run the business from a partnership, then because the husband's had PAYE income in the previous 3 years, then his share of the partnership loss, which could be anything from 0 to 100%, can be carried back to offset against his PAYE income, which would create an income tax refund. We already know that they're going to claim integral features, and integral features are a capital allowances claim, and that would increase the loss. Because he was a 75% tax, because he earned £75,000, he's a 40% taxpayer. Now, that means that some of the tax refund that he'll get will be at the rate of 40% by virtue of carrying the loss back. So this is a very powerful relief, and the capital gains advantages and income tax advantages militate towards buying the property in their own name rather than buying it through a limited company. So the key to this is you must consider the different types of scenarios as to why you would actually buy a property and how you hold a property, and then you need to consider the income tax reliefs, the capital gains tax reliefs, and the potential corporation tax liabilities to make sure you decide on all the different scenarios that could be possible, and then you can work out how to best advise your clients. At Wilkins Southworth, we always think through the problem.